Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The US and its allies prepare for a significant set of attacks against Israel from Iran that could come as soon as this week. Western leaders urging restraint. Oil slips after a 5-day advance with the threat of an escalation in the Middle East offset by signs of weakening global demand growth. Plus, Japanese stocks surge, fully recovering from last week's rout. Confidence in China, though, continues to crumble, with share transactions sinking to their lowest level in over 4 years. US inflation data in focus later. Let's check in on these markets then. After essentially a flat day across Europe and the US yesterday, modest gains being flagged by European futures, currently up 0.3%. We have PPI, producer prices out of the US. That is the inflation print to watch today as we lead up to CPI on Wednesday out of the States, along with inflation data out of the UK. Talking of which, the FTSE 100 flagged up by 24 points. S&P futures then pointed to modest gains of 0.2%. NASDAQ futures pointing up by 51 points. Let's flip the board and look cross-asset. Then the Japanese yen, weakness continuing for the second day. Of course, markets are back in terms of equity trading after that holiday of yesterday, and you are seeing those gains coming through from Japan. The Japanese yen currently at 147, down 0.4%. The benchmark US 10-year just below 4% at 390. And in terms of Brent, there you are at 81.80. 5 straight days of gains. Losses today in the session down 0.6%. Gold down by 0.4 at 2,462 per troy ounce. Now, the US says it believes an Iranian attack on Israel could come as soon as this week. That's as the Pentagon deploys more forces to the region. Iran has indicated it may retaliate after the assassination of Hamas's leader, Ismail Haniyeh, one of Hamas's leaders, of course, in Tehran last month. Bloomberg's EMEA news director, Ros Matteson, joins me now with the latest. And Ros, the warnings from the US and its allies, but particularly spokespeople out of the White House and close to the Biden administration, within the Biden administration, are becoming ever more concerning when it comes to the risks of further conflict in this region.
Well, that's right. It's interesting, in fact, because we're now, 2 weeks since the killing that Iran, blames on Israel of the Hamas leader in Tehran, and yet there's been no retaliation, even though every single day Iran has said we're going to have to retaliate for this, and nothing has come. And now we're hearing the US saying they believe it's getting pretty close. It could happen any time potentially this week, and it could be in many different forms, is what they're saying. Also, it could be a direct attack by Iran on Israel. It could also be the use of its many proxies in the region, Hamas, Hezbollah, the Houthis as well in Yemen. It could be a multi-pronged retaliation, but again in the realm, it seems, of something that's calibrated to avoid setting off that further war. And that's perhaps again why Iran has been taking its time. It's trying to work out what to do that sends a message back to Israel but doesn't trigger that broader war. But certainly the US is getting ever concerned that we're getting very close to it.
So the US is getting concerned. What is the US doing, along with its allies, to prepare for this potential Iranian retaliation?
Well, the US is sending ever more military assets to the region. It's already got quite a lot there, including soldiers at bases scattered around the region who are quite vulnerable. But also it's sending, it was already sending a carrier group there, the USS Abraham Lincoln. What it's been ordered to do now is to speed up, is to get there faster. It was due to go there for a rotation, so that will be in the region pretty soon. They also announced, a bit unusually, that they're sending a submarine that can carry Tomahawk missiles, more than 100 of them. And normally they don't publicise where their submarines are for obvious reasons. And the fact they're saying that is also to send a message to everybody: cool your jets. We don't want this to morph into something bigger.
Yeah, that nuclear power submarine, and as you say, revealing that will be in the region. Ros Matteson with the details in terms of how the US and some of its allies are preparing then around these risks in the region. Ros Matteson, Bloomberg's EMEA news director, with the latest. Thank you. Now, Bloomberg MLive's Mary Nicola joins me for the market reaction. And Mary, we have the data out of the US later, but we'll start on the oil story because we're seeing a little bit of softness in the session today around Brent, but still above $81 a barrel. To what extent this is about the geopolitical pricing around oil versus the details around that softer demand when it comes to Brent?
Yeah, there's still that premium that we're getting on oil prices as a result of geopolitical risks, and that's likely to linger, especially when you have these tensions escalating between Israel and Iran, and the fact that there is this lack of confidence of how this can evolve, of course. And so, of course, you're going to see oil prices remain elevated with that overhang still around, and then onto that, you've got from the other side pulling oil in the other direction is the softening demand, whether you're seeing weakness out of China or where you're seeing a slowdown in growth from the U.S. Obviously, there's a pull for demand to go lower. But as long as we have these geopolitical risks lingering, that risk premium is still going to remain on oil prices.
OK, so oil remaining one of the catalysts for these markets today. And we look ahead, as we mentioned, to the data out of the US. We have CPI tomorrow, but before that, producer prices out of the US. What are the markets expecting? What are they bracing for, Mary?
Yeah, Bloomberg Economics summed it up very well in saying that they're expecting a little bit on the high side for PPI. And the problem with that is what it does to filtering into PCE. And if we get a PCE that's not in the Fed's liking, obviously that delays Fed rate cuts even more. So, but the key thing here, whether it's CPI or PPI, is that the market needs a lukewarm number. What I mean by that is more, if it's too hot, then it's going to rattle concerns about stagflation. If it's too cold, it's going to bring up concerns about a recession. So it needs to be in that sweet spot to really get the markets comfortable. And of course, we've seen such a stark rally in U.S. Treasuries over the last 3 months and over the last month, especially as the markets are repricing where the Fed is going and looking for almost 100 basis points of cuts over until the end of the year. So that being said, if we get any setback, could really have an impact on Treasuries over the next few days.
OK, markets looking for a Goldilocks number in terms of inflation out of the US. Mary Nicola from Bloomberg MLive with the analysis and the preview. Thank you very much indeed. Let's cross over to Asia right now. Standing by for us in Singapore, Avril Hong with the details and the market check, with Japan back with a bang, Avril.
Back with a bang indeed. We're seeing it extending gains as the session progressed to more than 3% at one point. We're seeing it pair some of those gains now, but indeed the Japanese equities market is one that is playing catch up to the rebound that we already saw across the region a day ago. Flat on the Kospi and the TAIEX just tells you how fragile sentiment is and how important the US data will be this week, particularly for tech stocks. Now we're seeing the gains today in Japanese equities helped along by the weakness in the Japanese currency, and that's fueling the export-related stocks. But the other dynamic that's since been emerging after the market rout is how the froth seems to have been taken out of the market, making prices look more attractive. There's a bonus chart I want to show you, but let's flip the board and talk through what we're seeing in China across assets, because it is a market that has failed to revive animal spirits. There's lack of confidence there. We're seeing stocks there a bit flat today, but in terms of stock market transactions, we're actually seeing, based on the latest data, that it has fallen to the lowest level in more than 4 years. So really tells you how negative sentiment is towards the market. A lot of that has gone towards the bond market, that rally there that the PBOC is trying to curb. We've seen it taking more extreme measures in the past couple of days, including hearing about how for China's Jiangxi province has been telling these rural banks not to settle their recent bond transactions and purchases, essentially telling them to renege on their market obligations. So this is what we're seeing cross-asset in China. Flip the board, as I promised you, bonus chart where we talk about the yen stock correlation a lot. Another correlation is what we're seeing between stocks and bonds. It's turned positive just based on the recent sessions and how the stock market has climbed along with JGB yields. And this sounds like it is a bit counterintuitive because higher yields usually mean greater borrowing costs, not great for stocks. But in this case, in Japan, it actually tells us that risk appetite is emerging, returning again, and those investors are selling those bonds. Tom.
Avril Hong in Singapore with a market check and the bonus board as well. Avril, thank you very much indeed. Remarkable news coming out of China, as Avril was detailing for us, in terms of the transaction story falling to the lowest in 4 years, and then, of course, those interventions in the bond markets by the authorities in China. Here's what else we're thinking about today then. 7 a.m. UK time, we're counting down to this, and we will bring you a preview as well this hour in terms of what to expect. But it's UK employment data, so wages, claims and the jobless number. Really important, of course, at a time when expectations are that inflation will actually tick up in the UK. We're about that 2% target. We've had, of course, the first cut that's come through from the BOE, but the next steps from the central bank in terms of the UK, the BOE, will be crucial, and the wage data will certainly tie in to that debate. That drops at 7 a.m. UK time. 9 a.m. we get the IEA monthly oil report. We'll see to what extent they diverge or not from what we've heard from OPEC, who put out their oil report yesterday, and they have trimmed their forecast in terms of demand. So OPEC lowered their projections for world global demand this year by about 135,000 barrels a day on softer demand. We'll see if the IEA follows suit. And at 1:30 p.m. UK time, we do get the producer prices out of the US. MLive's Mary Nicola telling us that the markets are looking for a Goldilocks number. Not too hot, not too cool, of course, and that leads up to the CPI, the Consumer Price Index, that drops, of course, out of the US on Wednesday. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go on the terminal for the latest. Coming up, oil snapping a 5-day rally, and OPEC, as we mentioned, trimming its demand forecast for this year and next. We're going to do a deep dive on the outlook for crude, the geopolitical tensions, but the softer demand and how that's playing in to the world's energy markets. Plus, shares in German defence contractor Renk have soared this year as it benefits from increased spending by governments in Europe. We are going to be speaking to the firm's chief executive. That's at 6:40 a.m. So in just under 30 minutes' time after the company reports earnings. Stay with us for that interview. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Tuesday. Now, oil is slipping after a 5-day advance with a possible escalation in the Middle East conflict offset by signs of weakening global demand growth. Brent trading right now near $82 a barrel, 81.72 right now, after rising by almost 8% over the previous 5 sessions. Let's get the details then and bring in Bloomberg's Dan Murtaugh, who has a finger on the pulse of these energy markets for us. Dan, talk to us about the Middle East tensions then. We've been hearing about the US warnings that retaliation from Iran could come, and it could come as soon as this week. How is that playing in to the pricing around oil?
Yeah, we've seen a real roller coaster ride in terms of speculative interest when it comes to oil. If you go back, flashback a week or two ago, speculators were selling out their contracts. You had the lowest net longs and going back for years because they were concerned about demand, about the economy. And what these rising Middle East tensions have done has been to bring those speculators back in, betting that if something happens, it could escalate, that could start to disrupt physical flows and really raise prices. The whole time, physical demand has been pretty consistent. It's really just been whether your money managers are in or out.
And Dan, we've got an update. We're looking ahead to IEA and their report later today, but OPEC have come out with their expectations, their outlook for the oil market. What have they been saying?
Yeah, so OPEC has been more bullish than IEA or the EIA all year on crude demand. But just yesterday they came out and they pared back their expectations a little bit. They're seeing softness coming out of China. They're worried about maybe the possibility of the U.S. economy weakening, and so they're pulling back their forecast for demand. And even with all of this roller coaster ride around Middle East tensions, this is something that traders are really going to be keeping an eye on, because demand has been, especially in China, which is the world's biggest oil importer right now, it's been very, very, very hard to stay bullish on it. The economy has been struggling. The shift to EVs has pulled a little bit of wind out of the sails of the gasoline market there. And so, we'll see some IEA numbers out there later today. And I think a lot of people are going to be watching to see if there's any sign that China might rebound.
Yeah, absolutely. And you're right to point out there's been divergence, hasn't there, in terms of the outlook coming through from both the IEA and OPEC. So we'll see if that continues. Dan, what are the implications then for OPEC? They came through with a cut in terms of the output. Is that likely to be extended? What do we know about how OPEC is thinking about the relative softness in the oil markets at this point?
Yeah, right now OPEC is still withholding about more than 2 million barrels a day of production around their members, and that's lost revenue for all these countries that really need this oil revenue. So they would like to get those barrels back out on the market. And if you look at OPEC's forecasts, their strong assumptions on demand show that there is enough demand to pick up for them to start putting barrels back. They're looking at increasing by maybe 500,000 barrels a day by the end of this year. But if you think the lower forecast from the IEA or the EIA are right, that OPEC's going to have to trim down its forecast over the next couple of months, then it makes it much, much harder for them to bring back those barrels without really bottoming out prices, which they don't want to do. And so they're going to be in a real pickle because there's a lot of OPEC members that want to sell more oil and boost their revenues. And if they're not going to be able to, it's going to create more and more political strains with that group that, as we've seen in the past, doesn't always get along as good as you'd want.
Okay. Dan Murtaugh, really appreciate it. Great analysis and insights into what is happening around the oil price right now. The pushes and pulls, of course, in terms of geopolitics and the demand picture. Dan, thank you for the update. We'll stay on the China story as well because it's tying into what's happening around copper. Dr. Copper taking a hit in the session, currently down around 0.7%. And here's the story crossing the Bloomberg then on what is happening. And here's the China component. China then exporting copper. It's usually a net importer of copper. But given the weakness in that economy, in the industrial base of China, you're actually seeing details coming through from the London Metal Exchange where you've seen a flood of copper and nickel from China into some of these overseas warehouses. Again, China is the largest metals market, but the flows are going in the opposite direction. Chinese origin copper making up 72% of the increase in exchange monitored inventories in July. That again is according to data from the LME. So these exports from China pressuring the copper price, and that is a story worth keeping an eye on. You can see copper in the session today, currently down 0.7%. But of course, year to date, you have seen those gains of close to 5%. Staying with copper, BHP Group is ramping up efforts to avoid a strike at the world's biggest copper mine. The company says it presented a new wage offer to union leaders in Chile, which includes a nearly $30,000 signing bonus and improved benefits. Failure to get the union's approval would set up a stoppage at BHP's Escondida mine, which accounts for about 5% of all the world's mined copper. Fitch Ratings has cut Israel's sovereign debt by one notch as the war in Gaza weighs on public finances. Fitch lowered Israel's score to A from A+, citing geopolitical risk. Fitch analysts see the conflict in Gaza lasting into 2025, with a chance of it broadening on other fronts. Moody's Ratings gave Israel its first ever sovereign downgrade in February, cutting it one notch to A2 with a negative outlook. And Greek authorities say a large wildfire on the outskirts of Athens is showing signs of improving. The biggest blaze of the summer started northeast of the capital on Sunday. It's been fueled by strong winds, high temperatures and a lengthy drought. More than a dozen towns and villages have been evacuated, with police rescuing more than 250 people. Switching focus now, Elon Musk has pitched himself for a role cutting US federal spending in a second Donald Trump administration. The billionaire Tesla boss spoke to the Republican presidential nominee in a two-hour conversation on X.
I think it would be great to just have a government efficiency commission that takes a look at these things and just ensures that the taxpayer money, to the taxpayers' hard-earned money, is spent in a good way. And I'd be happy to help out on such a commission.
I'd love
if it were formed.
Well, you're the greatest cutter.
OK, coming up, Wall Street's big money managers are being forced into new ways of doing business in the Middle East. We're going to get the details on that story coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Wall Street's big money managers are facing a shift in the way business is being done with sovereign wealth funds in the Middle East. Today's Bloomberg Big Take explores how state-controlled funds in the region are increasingly asking private equity firms and hedge funds what they're willing to do in return for investments, rather than just handing out checks with no strings attached. Let's get more details then and bring in Bloomberg's managing editor for Middle East Money, Advaith Nair, who joins us from Dubai. Advaith, explain to us then what is changing for the likes of Apollo, Blackstone, BlackRock in the Middle East, in your region.
Morning, Tom. Thanks for having me on. So in the past, you'd see executives from the biggest hedge funds, PE firms, being able to fly into Abu Dhabi, Doha, or Riyadh and return with large checks. Now, that's changed. The region's biggest wealth funds control close to $4 trillion in assets, and they're keenly aware of their growing importance in the global financial ecosystem. They realize that they have greater negotiating heft, and they've gotten more demanding. They're asking Western firms, for instance, for breaks on fees. They're asking them to hold more events in the region. They're asking executives to set up local offices and bring more people to live and work in the region.
What are some of the concessions, the biggest concessions that these Wall Street firms have been compelled to make as a result of this shift?
I'd say the biggest one would be on fees. Increasingly, we're hearing Middle Eastern wealth funds pressing Wall Street firms for lower fees, for the rights to co-invest, for a greater share of profits. For instance, PE firms in the past have had a 2 and 20 model, which is a 2% fee and a 20% share on profits. That model is slowly fading away. Obviously, the Middle Eastern funds also have the ability now to work with asset managers that they have relationships with, which, as we say in the story, helps winnow the field a little bit. And of course, like we discussed, just this idea of asking firms what they would do for the region, how any allocation would help the Middle East, be it in terms of jobs or technology transfer.
OK, really interesting, some of the concessions around this. And look, you've touched on this, but kind of the reasons why these sovereign wealth funds feel that they are empowered to kind of make some of these demands. What are the key reasons that have come out from your reporting on this?
So that's an excellent question. I'd say the biggest reason, it all boils down to money. We, as I mentioned, the biggest Middle Eastern wealth funds are sitting on assets of close to $4 trillion. Now, that number, according to at least one estimate, is expected to go up to $7.6 billion. Now, that's a lot of financial firepower. And then if you look at what's happening in North America, the largest institutional investors are mostly fully allocated. Now, that means when asset managers want to raise funds, they have to necessarily look to the region. And that obviously gives the Middle Eastern wealth funds a greater degree of heft.
Really fascinating reporting, well worth checking out on the terminal, of course, and on Bloomberg.com. Bloomberg's managing editor for Mideast Money, Advaith Nair, thank you very much. Coming up, the UK's labour market in focus ahead of a week of important data, of course. It will be key for the Bank of England's next move. We will bring you a preview of the wage and labour data out later today, and then, of course, inflation, which crosses on Wednesday. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The US and its allies prepare for a significant set of attacks against Israel from Iran that could come as soon as this week. Western leaders urge restraint. Oil slips after a 5-day advance with the threat of an escalation in the Middle East, offset by signs of weakening global demand growth. Plus, Japanese stocks surge, fully recovering from last week's rout. Confidence in China, though, continues to crumble, with share transactions sinking to their lowest level in over 4 years. US inflation data in focus later. Let's check in on the markets then. It was a flat session over in the US essentially and Europe yesterday. European futures though pointing to a slightly brighter picture here as we count down to the wage data out of the UK in a little under 30 minutes time. European futures pointing to gains of 0.3%. The FTSE 100 looking to add 23 points. S&P futures pointed to gains of 0.2%. Raphael Bostic will be speaking later today. And of course we get producer prices as well for the first touch on inflation and prices this week out of the US ahead of consumer prices tomorrow. Nasdaq futures pointing to gains of 76 points in the session, up 0.4%. We'll turn the board and look at cross-asset with a focus, of course, on the Japanese yen because equities have come soaring back in Japan after the holiday of yesterday, helped by a weaker Japanese currency. 147 right now versus the US dollar, down 0.3%. The US 10-year at 391. Brent, after those 5 days of gains, weaker in the session, down 0.8% at 81.65. And gold trading at 2,460, down 0.5%. Now, as we mentioned, data due in half an hour is likely to show unemployment in the UK rising. Unemployment in the UK rising to its highest level in 3 years. The jobless rate comes ahead of inflation numbers and other data that could determine the BOE's next interest rate decision. Bloomberg's UK correspondent Lizzie Burden joins me now with a preview. What will you be looking out for then in the data this week, Lizzie?
Well, Tom, we've got an absolute slew of data this week. You mentioned the jobs data. We've got inflation as well. We've got GDP and retail sales later in the week. But the highlight could be that you see an uptick in inflation, and you haven't seen an uptick so far this year. So that would only fuel the caution on Threadneedle Street. If you remember to the last rate cut, it was really on a knife edge, the decision on the Monetary Policy Committee, a 5-4 split vote. And even before we've had any of this data, we've already had a warning from the arch hawk of the Monetary Policy Committee, Catherine Mann, saying that you cannot be seduced by headline inflation falling to the 2% target, as you can see there on the screen with the white line. She says she's still concerned about the labour market. So we'll get those numbers in just under half an hour. If we see a sharp uptick in unemployment, of course, that would pose fresh risk to the recovery from last year's recession, and that would add to the Doves argument to keep cutting. So at the moment, broadly, economists reckon you're going to have a hold in September and a cut again in November. But let's see, Tom, how this data play out.
Yeah, as you say, hold in September, markets pricing in 29 points in terms of the cuts coming through in November. That's the expectation. A further 44 points, so just fewer than 2 cuts being priced in by the end of the year. Where does it all leave markets at this point then, Lizzie?
Well, it's been an interesting story for the pound so far this year. It's still the best performing G10 currency, but it's been struggling for a momentum recently. So if we get softer than expected growth data later in the week, that could make sterling vulnerable to a leg lower. It's interesting if you compare the different central banks around the world. You've got traders expecting less easing from the Bank of England than the Fed and the ECB. And of course, the odds of a jumbo Fed cut are about 50-50 at the moment. We've got a chart that really shows the Bank of England has the tightest real policy rate of all the major 3 Western central banks. And it's the RBA in Australia that has the loosest. So you can see it there. There's the Bank of England. And then, you could see the translation through to the pound from that rate path as well.
OK, Bloomberg's UK correspondent Lizzie Burden with the market positioning ahead of this data, of course, crossing at 7 a.m. UK time, the preview, and, of course, what it could mean for the BOE. Really consequential day in terms of fleshing out that story. Thank you, Lizzie. Here's what else to be thinking about then for this week. 10 a.m. UK time. This is today. Euro area ZEW survey, the ZEW survey, the ZEW survey. That will give a gauge, again, in terms of the health of this Eurozone economy. As we look at now, markets pricing in a further 67 basis points of cuts from the ECB and almost fully pricing in September as the next cut from the European Central Bank. 10:30 a.m. UK time. Meanwhile, we're getting an auction of German 2-year debt, €5 billion. And at 1:30 p.m., it's the big data point of the day, really, after the UK. And it's PPI, producer prices, of course, for the month of July out of the US, and to what extent that could inform views around the Fed's next steps. And a gauge on the consumer before the market. Home Depot earnings crossing stateside. Again, a touch on the consumer and to what extent you're starting to see a bit of vulnerability there. Or maybe there's still resilience. Of course, that will be important as well in terms of thinking about the Fed. Talking of the Fed, 6:15 p.m. UK time, Raphael Bostic will be speaking at an event. To what extent, and will he push back on the market narrative that you need possibly a jumbo cut from the Fed in September? His comments could be consequential. Coming up, European defence contractor Renk is due to report any minute as spending on the industry surges amid that conflict in Ukraine. I'm going to be speaking to the company's CEO, Susanne Wiegand, next. Stay with us for that conversation. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Ukrainian President Volodymyr Zelensky has confirmed for the first time that his forces have seized a swathe of Russian territory, saying the operation is being conducted to protect his country's border areas. The fighting has pushed European gas prices to their highest level this year amid fears supplies will be disrupted, although both sides have indicated they'll keep the fuel flowing. Let's bring in Bloomberg's Tony Halpin for the details. Tony, how much do we know about Ukraine's operations inside Russia? You put it in that historical context for us yesterday, the first foreign incursion, military incursion into Russia since World War II.
Yes, I mean, that tells you the significance of it and how embarrassing in many ways it is for the Kremlin to have to confront this. And yesterday, Ukrainian officials met with President Zelensky, and the military told him that they had control of 1,000 square kilometers of Russian territory. That's about 386 square miles. Simultaneously, President Putin was meeting with his regional officials, and the acting governor of Kursk region, where the military action is taking place, told him that some 180,000 people have been evacuated from their homes. So that gives you an impression of the scale of what's going on, the psychological blow that's being felt in the Kremlin, and the encouragement and morale boost that it's giving to Ukraine at this point.
What is the situation when it comes to those gas supplies in the area then, Tony? We've seen a pickup in prices, European gas prices. What is happening on the ground? What are the risks?
Yes, this is all about a town called Sudzha, where Russia's last remaining pipeline carrying gas through Ukraine, incidentally, to Europe, is routed. There's a metering station there. It appears Ukrainian troops have taken control of that town. We have reporting from both Gazprom and Ukraine's Naftogaz side saying that it seems that Ukrainian troops have control of the town. But so far the gas is flowing. Both sides seem to have an interest in continuing the flows. Ukraine earns money from the transit, and Gazprom certainly wants to supply its customers. So far at least there's no sign of flows being interrupted. But the risk clearly is some accidental damage either to pipelines or the infrastructure, which then would put those supplies at risk, and hence, as you said, gas prices in Europe have jumped.
OK, Bloomberg's Tony Halpin with that important update, of course, when it comes to that conflict, Ukraine, Russia, and those forces, Ukrainian forces now on Russian territory, and implications around the gas supply as well. Tony, thank you for the update. Now, the outbreak of war on Europe's eastern border, and of course, as well as the possibility of a more isolationist second Trump presidency, have prompted many of the continent's politicians to rapidly boost defence spending. The industry struggling to keep up with demand as supplies are sent to Ukraine and nations upgrade their equipment amid the threat of expansionist Russia. German manufacturer Renk, who specialises in drive technology components, including for tanks and armoured vehicles, has reported earnings this morning. For the details, let's bring in the CEO, Susanne Wiegand, joining me now from Augsburg in Germany. Susanne, thank you very much for joining me. We're looking then at a second quarter in terms of the results coming through, a second quarter reaching an all-time high. You've also raised some of your targets, at least medium term. The annual guidance for 2024, approximately 1.1 billion euros in revenue, and your mid-term target increased by about 15% in terms of annual revenue growth. What is driving the demand? Is it all about Ukraine at this point, Susanne?
Good morning, Tom. Thanks for the interview. Demand is driving clearly the overall geopolitical situation and tensions globally. It's a Ukraine effect, but obviously also Middle East effect, an Indo-Pacific effect around the Taiwan question. So I think it's the global situation we have at the moment, and not just specifically Ukraine. Definitely in our case, it's as I said.
OK, so there are global dynamics at play here. We spoke to you, Susanne, back in May. You're very generous with your time. You said the order backlog at that point was 4.7 billion euros. Where does that order backlog stand right now?
The total order backlog is at 4.7 still, but we could increase by 200 million the fixed order backlog, which is a great development. And the total order backlog increased also by more than 10% if you compare to Q2 previous year, from the 4.2 billion to the 4.7 billion, which we have now. So very pleased with the market side of things and our financial performance with respect to order intake and also revenue top line growth.
And where does that leave inventories as well? To what extent there is a surplus in terms of the inventory story, and to what extent that could be supportive going forward?
Yeah, if you reflect our revenue growth in Q2, strongest growth on the aftermarket side, which shows that there is much more use of equipment and inventory building up. So aftermarket revenue grew in Q2 by 30%, even on the defense side, the business in total with almost 30% on a level of about 27. But also, and I'm very pleased to say that our civilian part grew by 24% in revenue in Q2. So great performance by all segments.
OK, so some of those inventories are being drawn down, and that is proving supportive. In terms of supply chains, this is something else you touched on back in May. To what extent have supply chains adjusted to a normal? Are they back to where you want them to be, supply chains, or is there still more work to be done on that front?
On supply chain, there's always some work to be done, which is normal. We are very, very pleased and glad that here in Europe and specifically in Germany, we have it fully under control and back to the, let's say, old normal. We have still some work to do on the US side with supply chain challenges, but overall, no issue anymore to be reported for us. And this is also reflected in the strong top-line growth, which we see on the VMS business, also specifically here with the performance of efficiency gains in the Augsburg plant. So very pleased here as well with the development of the last few months. OK, that's interesting. So improvements in terms of the supply chain in Europe, but challenges still in the US. What are the challenges in the US? There is still some shortages and some suppliers to be managed. But all under control. So we have dedicated measures there and see also very positive results. So the US activities are, let's say, 3 to 6 months behind what we have done here in Germany, but also very much on a normalizing path at the moment.
Talk to me about deals and cooperation partnerships. You recently signed a cooperation deal with the Italian company Iveco. What exactly does that partnership entail? And are you looking for further tie-ups like that, either here in Europe or beyond Europe?
Yeah, for us, it's important to have partnerships and close relationships, specifically with engine manufacturers. We are completely independent. But there's good solutions out there in the market, and we obviously speak to and cooperate on a project-specific basis and also on a platform-specific basis with the various engine manufacturers. Iveco has made some great developments in the past, and also with a view on not just only the Italian programs and the Italian market, but also the global reach of the two companies promise some good let's say, prospects and development going forward in the market. And this is what we agreed with Iveco to analyze specifically for the market for tracked vehicles, where we can come up for our customers with best-in-class entire power packs, meaning engine and transmissions in a package deal.
And Susanne, you've spoken in the past about a gap that exists between governments in Europe reacting to the conflict in Ukraine and the gap between that reaction and actually putting in orders for equipment and the kind of equipment that you and Renk supply. Has that gap extended or has it shrunk?
No, I think it has shrunk. So also here, very good development and good moves. Specifically in Germany, we recognize that things are now coming into play. Also with placing orders and in a positive and promising discussion also on the development and increase of the budgets going forward. I think nothing published yet, but we are rather close in all those discussions, and I'm very pleased with the development of the last months. Also with some of the countries around us, gap has been closed, and we see now reaction placement of orders, and this is also reflected in the financial figures in Renk and with our colleagues in the industry.
Look, I have to ask you this question because, of course, you sit within and on these geopolitical tensions and these fissures globally. There was an assassination attempt against your colleague, the CEO of Rheinmetall. Do you fear for your own safety, Susanne?
This does not leave me, let's say, cold and untouched, and we had to increase security measures here as well for our, let's say, premises and also for personal security. And I'm not fully scared. This I think is not the case, but definitely things have changed and times have changed in that regard, and it's not fun.
Yeah, I'm sure it's hard to imagine what that must be like. But to be clear, you and the company have taken additional measures to increase security as a result of these threats.
Absolutely. This is clearly advised, and we obviously follow that.
OK. Switching focus to the politics of the US, Susanne, what would a Trump presidency mean, do you think, for the defence industry of Europe?
I think it might increase or accelerate the pressure even more. Trump is rather clear in his view on what Europe should do, and with respect to investments and Ukraine aid. I think we know that, but obviously Trump will make it even more clear and maybe more robust in actions. So this, I would expect that this will increase pressure on the Europeans to act even faster. We have started now to close this gap from talking to acting, and I think this will just increase the pressure even more. And that's why no harm for the industry. Europe obviously needs that push.
Susanne, before we let you go, briefly on AI, how are you thinking about incorporating generative AI into your business, whether it's around creating efficiencies or into your weapon systems?
Yeah, since we produce, let's say, the propulsion system and not the weapon system specifically, AI plays a role in autonomic driving, in autonomous systems. It plays a role in predictive maintenance solutions. AI plays a role also in the next generation of suspension systems going forward, and this is increasing overall the safety and mobility of the systems we are providing.
OK, Renk CEO Susanne Wiegand, thank you very much indeed. On the back of those earnings and, of course, how the industrial complex around military components and military supplies is adjusting to the geopolitics. Supply chains normalising in Europe, but still some challenges in the US. We appreciate your time. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now we have a snapshot on the health of the US economy. This is just one snapshot in time. It's a weekly data set that gets updated, and it's the Atlanta Fed GDP Now data. And you've gone from sub 2% in terms of GDP, seasonally adjusted for the quarter on an annualized basis, sub 2% to 2.9%. in the second quarter. Again, it's a snapshot, but it does suggest that there is still resilience in the US economy. And that resilience, by the way, is putting something of foundation under the earnings story. Let's flip the board and have a look at what's happening on earnings, because Bloomberg Intelligence have put out a piece pointing out that in terms of earnings in the second quarter, you are starting to see this breadth now, away from the Magnificent Seven. So some of the smaller cap stocks coming through, the expectation from BI is that you're actually going to see income growth, earnings growth at around 7.4% from those companies ex-Mag 7. Now, the Magnificent Seven still expected to post earnings strength of around 35%, but that is way down from previous quarters. So that is something that could be constructive for those looking for that lean into US equities. There maybe is some grist to the mill for that story. It's a very different picture when you think about what's happening in China. Let's flip the chart and have a look in terms of the data coming through and the reporting from Bloomberg. What we're seeing in terms of the turnover, the demand for Chinese stocks, Chinese stock trading falling to the lowest levels in more than 4 years. The lack of demand coming through for Chinese stocks, the lack of confidence in that market. We know all about the real estate crisis. We've also seen some really fascinating moves to try and intervene into the bond markets. But in terms of the stock trading, there just is no appetite at this point. Now, some will see that as an opportunity to buy the dip. Others will suggest that maybe there's further downside. That is worth something bearing in mind. The trading around Chinese stocks falling by the most in more than 4 years. There's plenty more coming up this morning, including an exclusive interview, by the way, with the head of the IEA's oil market division. The details and their report, their outlook coming through. That is the agency, of course, releases that monthly oil market report. The opening trade is going to be walking you through all of that. It's up next. They've got the interviews, they've got the data, they've got the market deep dive. Stay with us. This is Bloomberg.